This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Welcome back to Invest Like a Pro. This is Joe Rabil. So what we're going to do today, I have had some questions related to intraday trading. I want to show you some things that I think can help you if you're an intraday trader. I also am going to apply it to some longer term type trades. So if you like to use the weekly and the daily together, I'm going to give you some ideas as to how I think a few nuggets of information that if you've gone through my book and my course, it might not be obvious, or you might be coming across this and wondering, okay, is this a trade or not? So let's go ahead and get into this. I want to give you a few examples. Okay, so I've got my 4 charts up, but I'm looking at this as if I were doing the intraday trading. And what I do, the template I like, the grid I like, is having a daily in the bottom left, a hourly in the bottom right, 10-minute in the upper right, and a 2-minute in the upper left. Now, typically when I'm trading, there are times when I'll take a trade hourly and 10-minute on an intraday basis, but it has to happen early in the day. Typically, if I'm most of the trades I'm doing intraday are going to be the 10 and the 2. If you like the 15 and the 3 better, that's fine, or even the 5 and the 1, you can do those as well. But let me just explain something. So the first thing I would do is I'm looking at this, and I come in, and let's just say it's, let's say it's 11 o'clock, 11, let's say it's 10:30, 11 o'clock or something like that. I'm trying to figure out, if I want to do an intraday trade, I'm trying to figure out, okay, what am I looking for today? Because what you want is to figure out what kind of day it is. All right. And so the first thing you want to do is actually pull up the daily chart and zoom in on this thing and stay focused in on just a few things. Number one, you want to look at where you are in relation to the 4. You do want to look at what's taken place the prior few days, but the key thing you want to do is look at the opening price. This is where it opened, right? And how it's doing today. So we had an open here, and we had a slight push to the downside, and then we've basically been up, and so it's obviously this is the close during the day, but you would see a position where you opened up pretty far away from the close of the prior day, pretty far from the 4. And you had tried to make a continuation to the downside, and you didn't, and you started to push to the upside. So when I see that, I'm thinking, the bias for the day is to push to the upside, and we're going to try and work our way closer to this 4 over the course of the next day and a half. And that'll often follow a 3-day down move where the biggest day of the 3 is a big red bar. Now, the way this would apply, if you were looking at it from a bigger picture standpoint, let me just switch this to a monthly chart. So on a monthly basis, we have, if you notice off the low, we had a little push, and there would have been a little red at the beginning of that bar, but then it pretty much finished green. And then there was very little red on this bar, pushed to the upside. Now it gave it back, but there wasn't a lot of red showing up. Now, we tried to push to the downside early in the month, and then pushed back up through the open for the month and remained green. Again, look at early in the month, it tried to drop, found support at the 4, and then pushed to the upside. Never got too far away. Really what this was doing on this pullback was filling in the distance from here to the 4, right? Then we opened up here, tried to push below, but the 4 is still rising, and then got back above, and then spent the month going up. Again, another green bar, green bar, green bar. Now look at the way this played out. We opened up here, and we tried to make a push to the upside. And then immediately we started to see red, really for the first time, red looking a little bit more like it had already tested the high, as opposed to opening up, testing the low, or trying to make a push to the downside. It did the opposite. And now we've been moving to the downside. It almost looks like it might want to even break the 4 or come in a little bit. So when I see that, and we're seeing our first sign of red early in the month, in relation to already having a push to the upside. Remember, we want to keep an eye on that open for the month. So I know that this looks like it wants to be a down month. Now, we've got about a week left, maybe a little bit more than a week left. It is possible this could come all the way back and form some kind of a tail. Probably not be a green tail, but it could form a tail off the low. However, the way I'm looking at this is I would view this as a down month. It just looks like it wants to be a down month. For the first time in all of these months, remember, we've gone through 1, 2, 3, 4, 5, 6, 7 months, and they've all been positive or pause bars, not one negative month in 7 months. So we're due. So this is how I would apply the same technique. Obviously, the answer is completely different when you look at a monthly than when I look at this daily chart here, stretched away from the 4, opening up, gapping down, having no follow through, and then turning green. So I know that on the onset, when I'm going here, I'm probably not thinking continuation to the downside. Now, if we go and look at the hourly chart, we got a 1 bar rally, 2 bar rally, 3 bar rally, and then we look to turn red and move to the downside. Now, I want to show a few things. When I go to the 10-minute chart, let's just go and look at what took place here, because this is where the hourly is pushing up, pushing up, pushing up, and then it basically has a red bar, and then it starts to push to the downside. And if we look at this, we could say, hey, you know what? This looks like almost like a zero line reversal with low ADX. Why don't we take the trend line break? All right. So why would I not take that trade? And I don't like taking that trade. And there's a couple reasons why. Number one, we were still pretty far from here. Okay. Number two, we really don't have reverse divergence in place. This is too far away to use that. And in fact, by that, and this was actually still making a lower high. And all the other, this is making higher highs with, and so is the MACD making higher highs. There's no reverse divergence here. There's no standard divergence here. I don't have that. I don't really have a zero line reversal. Now, I know there are times where sometimes I say, hey, this is close enough. But what is the difference maker for me? Number one, if I don't have reverse divergence and I've still got some distance here, I'm usually going to hold off on this trade and I will miss it. If it goes from here, I'm willing to accept that I'm missing that trade. Why would I do that? And the reason is that I don't want to be in a situation where I take a loss at the same area twice. And that means, let's say I short this and then it comes back up and I stop myself out. Right? And then it decides it comes up here and it comes back down and triggers again. Well, I'm essentially getting short in the same level 2 times in a row. I'm losing in the same spot 2 times in a row. I don't want to do that. This trade would have actually been a better trade if it played out that way, because we would have had the moving averages meeting together, crossing over, and we'd have a true zero line reversal with low ADX. So I don't want to get in a situation where I'm going to take 2 losses. I would rather miss this trade than take 2 losses. That's the way I think. Now, if you want to be more aggressive and you don't want to miss a trade, you do this trade and then you're going to have to take this, but then you're going to have the potential of taking 2 losses at the exact same area. I try and avoid that as much as possible. So I hope that makes sense to you guys. Now, if I'm thinking about this and I'm looking at the bias, and I already know that I had a little mini pinch play here, that developed into a little bit of a upside play. Look at this pullback. Now we have a rising 18. We get a tail formed off the low. All right. Now, when I see that, I'm going to go down to the 2-minute chart. I know I have a pinch play developed, and you could call this a 40 to 18 bounce. We have the 18 cupping around. We got close enough to the 40, even though it didn't quite hit it. To me, this qualifies as a 40 to 18 bounce. You could also look at it from a trend line standpoint. I mean, we basically broke this trend line. This is a little bit I don't know if you can really call that a trend line, but you can see that this is trying to shift the trend, breaking the 18 back to the upside, and now trying to hold the 18. Now, I will make one more point before I go to the 2-minute. You see what's going on with the this pinch play here, we still have plenty of room to the zero line. If this is taking place right at the zero line or just underneath, I'm probably not that interested in this trade. And in fact, I'm looking for that reversal signal I was talking about earlier. In this case, I still have room and I could take a trade that could go up 4 or 5 bars. But let's see on a 2-minute chart what the signal would have been. So that's back here. And this is the move to the downside, and we get our downtrend line break, and then we get a move to the upside, and then a test of the 18 on this time frame, and look, we get a secondary pinch. Now, this is pretty close to the zero line. This is not as important to me. It's the trigger time frame. It's not the trend time frame. So I am willing to take a trade where it's a little bit tighter to the zero line if I know that on the higher time frame, 10-minute, I've got room to the zero line. Hope that makes sense to everybody. So this is the trend time frame. This is the time frame that I'm saying, does it look like I have the potential to move up? Now, I want to make one point on this. I do recognize that this is just a counter trend trade, probably setting up a short trade. But do I have enough room in a 4 to 5 to 6 bar play to make some money to the upside intraday? We're talking about going from maybe 1 o'clock up to 1 to 2:30 or something like that. And I'm saying to you, yes, I think I can. If I can manage the risk and I can get the trade off on the 2-minute chart and I can enter here, and I would probably, I know in the book I said use this as your stop. Now you're welcome to do that. I would probably go and figure out what 2 ATRs is on the 2-minute and make sure I'm giving it enough room just in case there's a little noise here. There's always noise. Anything under 5 minutes, 5 minutes or lower, you're going to get a lot of noise in the price action, and it just gives you a little bit more breathing room. You can base the size of the trade off the 2 ATRs and then manage the risk that way. Start taking targets as it moves up, and you should have hit several targets in this trade as it moved higher. It eventually been stopped out somewhere as it re-entered, most likely on the last piece, or depending on how you want to play it, you might just take target, target. You might have been out of the whole thing. Now, there's a couple points I want to make. I know there's a lot of guys out there, and the way I learned intraday trading is that, they want to trade really from the open until about, maybe till about 11 o'clock. This is where they feel like this is the really high end intraday trading. And I guess if that's all you do is intraday trade, you do want to try and take advantage of that. And I'm not saying not to trade at that point. So they'll say that, and then they'll say from 2:30 to around 3:30, right, is the other high end period. You want to kind of avoid the midday doldrums. All right. And the reason why I'm bringing this up is that a lot of the trades that I do that are based off of a 10-minute chart or a 15-minute chart are going to take place inside that basically 10:30. I would say anywhere from 10:15 to 11 o'clock, 11:30, you're going to see some things triggering using a 10-minute chart or a 2-minute chart. It happens all the time. The other time is like 1 o'clock to 1:30. It will happen. So if you're following the rules that are in my course, don't be overly consumed about the timing of an intraday trade. It can happen pretty much any time. And the reason that it happens is because you're essentially trying to make up for what's taken on the open and let this thing play out a little bit until we get a setup. A lot of times if there's a gap in either direction, it takes about an hour to work that off and set things up. And so that's really what took place here. It took a long time for this to finally set up, pulling back to a rising 18. We had our setup here based on the MACD and the ADX. And then we got our trigger with the 2 time frame pinch play, ended up working out very, very well. All right, so I hope all of this is helpful. Let me know if you have any questions or comments. Thanks.